You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello, welcome to The Investor Way with me, Sam Ball, and my co-host John McEwen. In this week's episode, we're going to be constructing a £1 million fantasy portfolio. So, John, you all ready?
As ready as I can be.
Right, okay. So I thought it'd probably make sense to start, do top down, so start with the actual allocation of the portfolio first. So my suggestion was going to be 20% commodities, 40% index funds, and 40% individual stocks.
I mean, that sounds sensible. I suppose you're getting it depends how optimistic we're being about our stock picking. But if you've got a generous allocation or a significant allocation to the index, then you're not going to be able to either significantly underperform, but also significantly outperform. So it's going to, I suppose, balance the portfolio.
The thinking was as well, because it's £1 million fantasy portfolio. If I had £1 million portfolio, it wouldn't be just in individual stocks.
That's fair enough, really. That's to reduce the volatility, is it? Of your, with that,
and also the risk. Like if we actually had £1 million portfolio and we picked all the stocks ourselves and we cocked it up. That's it's just that there's damage limitation as well, isn't there? And I think although the index funds are going to drag us closer to a market return, there's certainly not. A market return is still very respectable,
depending which market you pick.
Well, yeah, that'll be the debate.
And then, we can come on to that when we discuss which.
I think we both agreed on the commodities just from reading the Ivy portfolio, really. So I think the idea of that is to produce a good real return. And again, it's going to have a lower correlation to the stocks and the index funds, so it should hopefully help us maintain positive real returns whilst reducing the volatility of the portfolio.
That's right, and it's also a hedge against inflation. That could be another argument. And
yes,
it depends which country you're coming from and what your currency is. But it depends. And I mean, we're speaking from a British perspective. There's a lot of quantitative easing. It's unclear whether we're going to have negative interest rates, this sort of thing. So it's a hedge against inflation.
Okay, so should we start with the 20% commodities?
Yeah.
My suggestion for that was going to be 2.5% Bitcoin, 17.5% Bloomberg Commodities Index.
Okay. I mean, I think that's very reasonable. At the moment, Bitcoin isn't included in the commodities index. So I think it's probably very reasonable to have, 2.5% in Bitcoin. I mean, do you want to talk a bit about that, Sam? Why you would allocate some of the portfolio? I mean, we did touch on it in the last episode about Bitcoin and the arguments for it being part of your portfolio.
Yeah, so it's just view it as a commodity, really, a digital gold. And like you say, it's not included in the commodities index at the minute. And it is an asset that I think I certainly want exposure to in the portfolio. And I'd want a small enough amount that if it does well, the portfolio could do quite well. And if it doesn't, the portfolio is going to be fine. So it's a bit of a hedge, really. And I think the 2.5%, it's actually the same percentage that Ruffer are using in their portfolios, which we discussed last week. So I'd say if it's good enough for them, it's probably good for us.
Yeah. And in terms of the Bloomberg Commodity Index, so what do we actually have on there?
So here we go. The index is composed of futures contracts on physical commodities. 24 commodities are eligible for inclusion, covering 6 commodity groups: energy, grains, industrial metals, precious metals, softs, and livestock. Commodities are weighted 2/3 by liquidity and 1/3 by global production, with caps on individual and group weightings to ensure diversification.
And it's available through an ETF. We're using the Invesco one, and very low fees. So that's another bonus of it.
Right, so we've got it. And it's immediately, we're down 1,500 quid already. I don't know if that's...
Is that trading fees?
It could be trading fees, so at least it's realistic.
Yeah.
I think it must be trade. I mean, it's still under 1%, but there you go. That's a good start.
Okay, so you're already underperforming.
Yeah, right. So we've got 175 grand of the commodities index. Right. So should we move on to the index funds?
So in terms of the index funds, I think you could make an argument for a couple, and it depends how you would want to do it. There are more straightforward ways if you wanted to minimize the number of funds. So you could get a fund like the Vanguard World Index, which is sort of, I think, weighted on the basis of market cap to the whole world. So on that basis, because a large amount is in the US, it's possibly about 50 to 60% US or North America weighted. It covers, I think, about 90% of the capitalized world. So you're getting a huge exposure, and it is a very balanced fund. I mean, I would argue for using that. If you wanted a greater weighting, you could use a combination of individual sort of countries, like to have S&P 500, we could have emerging markets, and you could tweak it depending on how you felt each index or what sort of exposure you wanted. Did you have any thoughts on how you would like to allocate that, Sam?
So I actually didn't want the world index because of the high weighting to the US. I think like 50% weighting towards US is too high anyway for a UK portfolio. Plus, we're going to have another 20% US in the individual stocks. Yeah. So because of that, I would have picked the individual funds.
Okay. That I suppose that's fair enough. I suppose if we're going for 20% US individual stocks, then yeah, you might want to reduce that a bit. Okay, and I mean, I am biased towards the US. I think if you look at it in the last 10 years and just at the individual stocks, it's got such quality companies, possibly more, well, I would argue more than any other stock market. And in the last 10 years, I think the S&P 500 has done nearly 200% return. The Nikkei is the second best performing. And I think that's maybe in the sort of 170%. And the UK is down at under 10% in the last 10 years, or the FTSE 100.
I wasn't planning on having any UK on any US in the index, but it sounds like you do.
It depends how confident you are in your US picks in the individual stocks, I suppose. That is what it comes down to.
I think I'd be happy to have a small weighting towards US if we want to. Maybe if we just agree on the index funds we want, and then I don't know what the easiest way to do it. Divide by the number of funds, the 400,000.
Okay, so we could have an allocation to S&P 500 then.
Okay.
But probably, yeah, like you say, balance it on the basis that we're going to have 20% of portfolio on individual US stocks anyway.
Do you know what is it? VUSD, it looks like it's a ticker.
Yeah, I mean, you'd be able to get iShares or from BlackRock, or Vanguard will have the same. We could go for an accumulating fund. That's probably the best. Let me just check that. Check the ticker.
Okay.
And then the other question is whether you go for a synthetic fund or whether you go for sort of a physical, the real deal.
I'd go for the real deal.
Okay, we can go for the real deal. The advantage, if anyone was considering it, of a synthetic fund is that if you're a UK investor and you're holding a US index, for example, the US government do tax you, and I think it's 30%. You can reduce it to 15% if you fill out the correct form. I believe that a lot of the ETFs that are listed that are available to us on the London Stock Exchange are based in Ireland, and they have an agreement, so it's 15%. But that does mean that on the yield or the dividends that are paid, you will be getting less over here. Some people would advocate for a synthetic fund because using derivatives, it doesn't actually hold the underlying stocks. Therefore, it doesn't have to, the withholding tax is not applied to it. But I suppose in times of extreme volatility, how strong is the synthetic fund, and is it actually going to be able to replicate as it's intended to do? I guess that's the query. We'll go for the iShares one, which offers an accumulating one, and the ticker is CSPX.
Right. So, are there any other funds that you'd want to include?
I suppose you'd always probably want exposure to the emerging markets. So an emerging market index.
Agreed. So I'd pulled out the Vanguard FTSE Emerging Markets. I think that's an income rather than accumulation. So I don't know if you want to find one that you're.
I'll see whether we've got. With the accumulating ones, it makes managing your portfolio easier if you just want things to be reinvested. That would be the main benefit, because assuming that this isn't in an ISA, you'd be paying the tax on it anyway.
Yeah, I'm assuming we're not going to be able to get £1 million into an ISA.
No. Well, Sam, you have ISA millionaires.
Yeah, but they don't start by putting £1 million in, do they?
No, they don't. No, they don't. Okay, we could go for the iShares Core MSCI Emerging Markets ETF, which is ticker EMIM. I think it's about 30% China, or 27%. You can get one excluding China.
I don't think so. It's the top 10 countries in the iShares Emerging Markets Index. 13.58% Hong Kong, 13.44% Taiwan, 13.42% China, 12.04% South Korea, 11.07% United States, but that'll be probably Chinese companies listed in the US. So like Baidu, for example.
Yeah.
8.17% India, 5.35% Brazil, 3.62% South Africa, 2.82% Russia, and 2.66% Saudi Arabia. I have no issues with having China in there, because I would want some exposure to it. And when it's part of the 40% and it's going to be a smaller part of that, and then it's only going to be 23% of whatever that bit is, we're not exactly going to be overexposed. So
absolutely. Yep. We'll go for that.
Right. Okay. So that one can go in. Do you have any others that you want, actually?
I'll let you go on to the others.
Okay. So we might need to do the same thing where you need to go and find an accumulation one.
Yeah, that's fine. That's fine.
Okay. So next up, I actually did want some exposure to Japan.
Okay.
So the one I had was the Vanguard Japan ETF, but that, again, all mine are income, so we'll have to find another accumulation.
I mean, it's not critical because
we may as well be consistent.
Yeah.
I don't know if there's a way to set this portfolio to reinvest the dividends. So it makes it easier in 6 months, a year's time, because we don't want to come back. We've just got this pile of cash and we can't split it up. I mean, we're going to have that with the dividends from the companies, but I think we want to minimize it.
So SUJP.
Okay. Yeah, that looks right. So iShares Japan. Okay. So next, I wanted Asia Pacific, excluding Japan.
Okay. We could just use the Vanguard one.
Looks like they've only got one fund.
Oh, we'll just use that.
Right, we'll keep VA. So the ticker's VAPX. And it's Vanguard Developed Asia Pacific, excluding Japan. Top 10 countries in there: 37% Australia, 31% South Korea, 17.5% Hong Kong, and 6.5% Singapore, and then 2% New Zealand. And there's a few other tiny ones. Right, okay, so that one's staying. And then my last one, I don't know if we want to try and find an accumulation one, but it's a Vanguard FTSE Developed Europe, excluding the UK fund.
Probably what you have may well be an accumulating one.
Well, I've got VERG.
Oh yeah, VRG. Yeah, that is. It is.
It's accumulating.
Yeah.
VERG. Right, okay.
Yeah.
So keep that one as well then. Right, so that gives us 5 funds, unless there's any others you want to add.
No, that would be, you've got it well covered that.
Yeah, so we'll have exposure to the S&P 500 in the US, Japan, emerging markets, developed Europe excluding the UK, and Asia Pacific excluding Japan, which we've got separately.
For reference as well, if you looked at the world index, the UK would account for about 4.5% of that. And obviously we're going to be choosing UK stocks for 20% of the portfolio. So we are, it sounds like we're allocating to the rest of the world more than the UK, which we are, but as a proportion of the UK in terms of its market cap compared with the world, we're going to be over UK. We're going to be over representative of the UK.
We will be underrepresentative of the US as well, though. Interesting, because we're not going to be near that 50-60%.
No,
but the thinking is
we're not going to be far off.
No,
actually,
well,
no, we are actually.
We're probably going to be about 30%.
Yeah.
But it's what's quite good is it gives us exposure to the parts of the world that we're not going to have exposure to through the individual stocks. So it is a global portfolio. As well, there's some areas where I would possibly want more exposure that in a world fund you'd hardly get any because you are so heavily weighted towards the bigger countries. Right, so we've got 400,000 divided by 5. So we've got 80 grand to go into each fund. So I'll just do that now.
Okay, so sorry, we've just changed the Japan index fund, and it's just to one that's listed in the UK and that's accumulating. And the ticker is Sam?
It is SJPA now.
SJPA, brilliant.
Yeah.
All right. So next, we've that. Well, in fact, I think that probably completes our index section.
Yes. So it's just the individual stocks now.
Okay. So who wants to start?
I can. Right. So just so for what we've done, I think I don't know if we've mentioned this earlier or not, but we've got 40% left to allocate to individual stocks. We've split that. So 20% of it is going to go towards UK listed and 20% is going to go to US listed. We've then each come up with a list of UK and US stocks, and we're going to decide on 10 UK stocks and 10 US stocks, and each one's going to have 2% allocation. Do you want me to run down my UK list?
Yeah, go on.
Right. So what we'll do is we'll see if there's any that are on both our lists, because that'll make it nice and easy. So my UK list, I've got Unilever, Money Supermarket, HomeServe, Hargreaves Lansdown, Tritax Big Box REIT, Ibstock, Rightmove, Diageo, Rathbones, and Imperial Brands.
In terms of the companies you listed there, some of them definitely, I think, Sam, I'd be with you all the way on Unilever. It's not too expensive. I mean, it's never cheap as a company, but very high quality. It's got growth, but it's also quite defensive in nature. So that would certainly be one that would be on my list. Money Supermarket, it's a company that we have discussed. It wasn't on my list, but I wouldn't be opposed to it. And that's obviously price comparison, and it's not looking particularly expensive. What's the price to earnings at the moment with Money Supermarket?
About 13 at the minute, I think. That might be normalised though. I don't know if that might not take into account the most recent results. Yeah, so that's normalised. I think it's closer to like 17 at the minute.
Okay.
That is on depressed earnings because of COVID. So on normalised, that 13, 14 where it's been in the past, that's probably where it is once it gets back to that.
That's right. And I suppose in the current context with the vaccine and the UK now having a trade deal with the EU, you could argue that it could be looking more positive for 2021 and some more certainty.
We've covered it a couple of times, and just the growth's good, especially when we compared it to Go Compare. For me, it blew it out of the water. Dividends over 4%. The growth's quite nice. It's not amazing growth, but it is decent growth. So yeah, I think with the yield and the potential for capital appreciation, I think it's very fairly valued. And going back to Unilever as well, it's possibly that's yielding about 3%, isn't it?
It is, yeah, it is. And then HomeServe, that's a company that I think we both liked. So one that I didn't really know much about. And it's also got sort of an online element to it and more of a tech sector. Tech play on it. Do you want to talk a little bit about that, Sam?
It's like the home boiler repairs. That's the core of the business. But then they've also got what's called the Home Experts division. So that's like, it's almost like an Uber for tradesmen, and they've got all these like price comparison sites, and they've got them in a number of countries. So they've got one in Italy as well. But at the minute, they're not really contributing anything to the bottom line, but that's expected to change in 2021. And what we quite like about it is that even if that home expert side of the business doesn't take off in the way that we're hoping it will do, the core business is still a very good business. It's got a PE ratio of about 25. The dividend yield's just over 2%. And even if the home expert side doesn't work, we think we're quite happy holding the core business. So
then we've got, you mentioned Hargreaves Lansdown. So that's an online stockbroking platform, the biggest online stockbroker in the UK. And again, that's one that's come up. I think it's one that we both like. What were your reasons for popping that on the list, Sam?
Yes, it's the market leader in what is still a growing market. I think it's a quality business. The dividend yield's over 2% now. It's at a normalized PE ratio of about 26, and that's for a company that's grown revenue from 388 million in 2016 to 550 million in 2020, and has grown earnings from 37p a share to 66p a share in that same time period. So when you look at how it's growing, it's now got quite a nice dividend yield. It's the market leader. To me, it looks quite cheap for the amount I'd still expect it to grow, because it is still in a growing market, and it's probably likely to continue taking market share off the more traditional money managers and stuff like that, because it is a very good platform.
That's right. I suppose another similar company to that would be AJ Bell, which is, I suppose, a smaller competitor and is growing, I think, a little bit. It's a bit more pricey, but then again, I suppose it's trying to perhaps grow market share a bit more aggressively.
Well, we did look at AJ Bell, and the numbers were very respectable.
Yeah.
I'd prefer the safety of having the market leader when the market leader looks like such a good company anyway.
Yeah, no, that's true. Okay, and then you've got Tritax Big Box REIT. So was that suggesting really just to have some sort of income play as part of the portfolio, or as part of the UK portfolio?
Yeah, so the dividend yield, I think it's about 4% now. I don't think you've got huge prospects of capital growth, but it's very, very secure. So what they do is they let out the massive big distribution centres. They build them like near motorways and stuff like that, and then they let them out to companies like Amazon. So it's very, very, it's not like a traditional REIT where it's in danger. It's a REIT that's, if anything, COVID's helped it, because more and more companies are switching to this online model. There's going to be more demand for distribution centres, and there aren't that many of them. So yeah, I just think it's a quality business, and there's probably not going to be a huge amount of capital appreciation, but I think it is very low risk and a very respectable dividend.
Yeah, I mean, I had a similar company on my list, which was Segro, and that was, I suppose, the same argument might be made for Segro. That's a company that, is again sort of warehouse based, and it's possibly slightly bigger. It's got a market cap of 11.3 billion, and its price to earnings about 15. But that has performed very well over the last couple of years on the back of the growth in the online e-commerce, Amazon. So I wouldn't be opposed to having either of those companies, to be quite honest.
Do you have a preference?
I suppose if you were to make the argument of the market leader, so Segro would probably be the bigger company and the market leader in it.
What's the ticker for Segro?
It's SGRO.
Okay, go with that one.
I mean, its share price growth in the last 5 years has been very impressive. It's been about 131%, and that's excluding dividends.
What's the yield?
So yeah, it's about 2.2%.
So lower than Tritax.
Yeah, it is less of an income.
Oh right, is it not a REIT then?
No, it's a company. It's yeah.
Okay.
So Ibstock, what is Ibstock?
It is a brick maker.
Okay. And I mean, I did sort of factor in having a house builder on the list. I hadn't thought so much about the brick maker, although I suspect they probably move in sympathy with one another on the market.
They do, but a house builder will be affected by house prices, whereas a brick maker is only really going to be affected by the volume of houses sold.
Okay.
So it's a bit safer, I'd say.
It's a bit safer, but okay. what do you think of the house? I suppose just more generally, what do you think of the house building sector? And I suppose you could have the brick makers, further up the line as well, in terms of going into our portfolio 2021.
I don't know about 2021, but long term, we do have an undersupply of housing. So, and from the brickmaker's perspective, we can only produce about 80% of our bricks. We have to import 20%, which isn't very good at all because bricks are cheap and they're heavy. So they're not really something you want to be importing. So really, as many bricks as Ibstock can make profitably, they're going to sell. In terms of the long term for the housing market, I just think we've got an undersupply. So whatever happens in the short term with like whatever policies such as Help to Buy and stuff, in the long term, I would still expect house builders and brick makers on the back of that to do quite well.
Yeah. In the sort of short term, we've got now more certainty after the Brexit deal was announced, and also again coming back to it, but the UK has been sort of devastated, but as a lot of the world has been, by coronavirus and by the lockdowns. We're currently in almost a national lockdown now. If you were to be an optimist, we're hoping to have most of the vulnerable people vaccinated by the spring. And hopefully that would mean that, assuming that this vaccine accounts for the sort of some of the mutant strains, that we could return to an economy more as normal by the summer. So that's something that would be very positive, especially for the house builders and the domestic UK focused stocks.
So would you prefer a house builder or a brickmaker?
I was tempted by Taylor Wimpey. We did discuss it back a few weeks ago, and that they'd been quite aggressive during the lockdown. They had done a capital raise and they'd bought up land at the depressed prices, which, looking at it now, may have been, assuming we've got more of a recovery on the way, may have been quite a shrewd move. So I would be quite keen to have Taylor Wimpey on the list.
Okay, we'll go with that instead of Ibstock then. Is that TW the ticker?
TW. Right move. So a lot of people in the UK are probably familiar with it if they've ever looked at either renting or buying a house. It's an online portfolio. It's an online platform which is it's website and it's got a successful app, but it's essentially almost like a platform for estate agents. Would you say?
Yeah, I think so. Yeah, so it's just a platform for listing houses. So it's for a lot of people, I think it's the first place you go to now, isn't it?
The name is synonymous with it, really. So that's where people go to look, and estate agents have to pay quite large fees to put the properties on. But if you want exposure and you want the property to sell, that's where the buyers and the renters are looking.
Yeah, I mean, what I like about it is it's basically a legal monopoly. I mean, you've got Zoopla as well, but it's Rightmove. I can't remember whether it's got an 80 or an 85% market share, but it's so high that it's basically a monopoly, really.
Yeah, that's right. And it's a monopoly that doesn't look like it's going to be, or at the moment at least, subject to that much regulation. So it's sort of can continue and make the profits almost as a monopoly as well.
Yeah. What are your thoughts on Rightmove?
I like Rightmove.
Okay.
Also got Diageo, and it's a company you may not have heard of, but you've probably, if you've ever been to a bar, you've probably come across its products. So it makes Guinness, and then also the other sort of side of the business is spirits. So it's a distiller, and it makes Smirnoff vodka, Captain Morgan. It's got a Tanqueray gin. It's got sort of a portfolio of spirits, and it's obviously UK listed, but very high quality brands, and sort of, I suppose, quite defensive in nature. But it is investing in new brands, and it's growing into emerging markets as well. So it's a big company. Its market cap
just under 70 billion.
Just under 70 billion. So it's one of the biggest companies on the London Stock Exchange. It's never that cheap, but for the growth that it's delivered over the years and over the last 10 years, it's, in my book, it'd be justified and a quality part of your of a UK portfolio.
I'd lump it in the same category as Unilever, where it's just such a quality business. And I think the fact that we don't have any UK index funds means I would, if we had UK index funds, I'd maybe say, oh, do we want it in there because it's already such a large part? But yeah, I don't see how you can not have some exposure to it.
No, and again, I mean, we come back to coronavirus a lot, but with lockdowns sort of hopefully being lifted on the horizon, more people returning to nightlife, you'd hope that it would really benefit from that. Obviously, people can drink from home, but they'll probably do both in the next year, we'd hope. Next on the list, you've got Rathbones. So that's a wealth manager, isn't it, Sam?
Yeah, so we've looked at quite a few wealth managers. So we've looked at, in the last few weeks, I think we've looked at Rathbones, Brewing Dolphin, and Schroders. And I do like all three. So it was just a case of which one. So it really was a toss-up. I would have been happy to go with either of the other two. So if you've got any leaning towards those, I'd be happy to go with it. But Rathbones, the growth was just a little bit better, and I thought the PE ratio was still quite reasonable. So I think Brewing Dolphin might have had slightly better growth than Rathbones, but it was a bit more expensive. They're all about,
and it's a bit smaller. I think Brewing Dolphin is quite a bit smaller than Rathbones.
I think they're about the same size.
Oh, are they the same size? Okay.
Schroders is about 10 times bigger.
Schroders is the big dog, yeah.
But they're all yielding about 4 to 5%. So it was a toss-up, really, and I went for Rathbones in the end.
Yeah, no, I'd have no issue with that.
Okay.
And then last on the list, we've got Imperial Brands. So I suppose Imperial Brands, you could argue with Diageo, it depends what your view is on the ethics of it. And a lot of ESG investors probably would stay away from it. If we don't go into the ethics, but we look at it purely as a company, what do you think of it, Sam?
PE is about 6, dividend yield's about 10%. If you look at it, if the company survives 6 or 7 years, you've got your money back on an earnings basis, and most of that would have been distributed to you through dividends. So it's just at such a depressed price where I think it's still possible, but it's hard to lose on it over the long term. Unless there's some massive regulatory thing that we've not anticipated, or some massive acceleration in people stopping smoking. But I don't anticipate either of those.
Because I suppose the UK proportionately has quite a big allocation or big part of the FTSE invested in tobacco. So there's British American tobacco and there's Imperial tobacco. Imperial tobacco, or Imperial Brands, is the smaller of the two. I believe it's more UK focused in that more of the brands, they're less international. They're more sort of your Lambert and Butlers, I think. It's Bristol based and has been for a couple of 100 years. And like you say, it's incredibly cheap on the accounting basis at the moment. Depends what your views are on, well, aside from the ethics, but when people are going to stop smoking. But in the meantime, they've got an addictive product and they're able to raise the prices if there are increased taxes. And they're a company that I suppose is very familiar with regulation and the change of regulation. And they've been dealing with that for probably the last 30 years.
Would you have it in there, or would the ethics stop?
I'd let you make that call, Sam.
Are there any of us on your list that you would rather have instead?
So on my list, I mean, we've discussed Taylor Wimp, we've discussed Unilever. I think Tesco's, there'll be a case for having that as part of the portfolio. Again, it's a quality business. It's turned itself around in the last 5 years and it's not that expensive. So I'd have Tesco potentially on the list. Other companies, wouldn't advocate too strongly, but DS Smith, I think that had cropped up. Not hugely expensive. That makes boxes, and that's sort of on the back of the trend of e-commerce and Amazon. So it could deliver quite a lot of growth, and it's not probably you could make an argument on the valuation at the moment that it's quite attractive, that it could deliver that growth. Diageo, I had AstraZeneca, so pharmaceuticals, which is another bigger UK sector. So I think AstraZeneca has got quite an attractive drug pipeline. It's got a market cap of 94 billion, but it's recently dropped from its highs back in the summer of about £91 a share. It's now down to 72, which is probably close to where it should be. It's got a price to earnings of 38. I would potentially have AstraZeneca on the list as part of the UK allocation. Other companies that have sort of been on the radar, but I hadn't looked in too much depth. There's Primary Healthcare Properties, which is essentially a REIT. So it would be, similar to your big boxes, but it really specializes in UK GP surgeries, which obviously there's a big demand for at the moment. And essentially it buys up GP surgeries and it leases them back on long leases. So sort of typically 25 years. So it's got a very stable income stream. And the other thing to note with the GP surgeries are that the contracts come from the government. So they're generally, assuming you continue with the current form of the NHS in the UK, they've got a very, very stable income stream. It used to be a bit cheaper than it is now. And it used to sort of yield, a few years ago, sort of 6%, but the share price has grown. So it's now probably about a 3 to 4% yield rather than, the really juicy yield that it had before. But I think that company is, as an income play, is probably quite attractive. There's Experian, which is a credit rating agency, which has been delivering a lot of strong growth. It's the UK's leader. I'll just check its market cap. So its market cap is about 25 billion, and it's been delivering really strong growth over the last few years. And I suppose it's essentially trading in data. So that would be a possibility, but I would probably advocate for having AstraZeneca on. Imperial Brands, I mean, it's on paper, it looks like a really strong company.
It was a toss-up for me between Imperial Brands and Tesco.
Oh, was it? Okay.
But I'd say if Tesco's on your list, I'd be quite happy to put it on.
We'll go with Tesco's then.
Are there any of your other ones that you'd strongly want on? Because we can. We've still got 7 of my original list, and I appreciate there was a bit of overlap, but you've probably got. Okay. You could probably push for another of yours if you want to kick one
I would probably push for AstraZeneca. I think.
Who are you kicking off?
Who are we kicking off? So are we up?
We're at 10.
We're up to 9 now.
Well, we're up to 10.
Okay.
Do you want me to run through?
Just recap. Yeah.
So we've got Unilever, Money Supermarket, HomeServe, Hargreaves Lansdown, Segro, Taylor Wimpey, Rightmove, Diageo, Rathbones, and Tesco.
That's a difficult one. I'd maybe kick off Rathbones, but because we've got HL.
I'm happy with that. Right, so are we putting AstraZeneca on?
Yeah, we're putting AstraZeneca on. Okay.
We've got our UK one sorted, so I'll just run through it one final time. So we've got Unilever, Money Supermarket, HomeServe, Hargreaves Lansdown, Segro, Taylor Wimpey, Rightmove, Diageo, AstraZeneca, and Tesco. We're going to be throwing 20 grand at each of those. Right, so those are now added to the portfolio. So we've just got our US stocks to pick.
Okay, so should I kick off, Sam?
Yeah, if you want.
So my top US pick would probably be Disney. So Disney, I suppose you don't really need that much explanation. I think everybody's heard of it, but it's had a few exciting developments. So obviously 2020 was a bad news for the park side of the business, with COVID, social distancing, and having to close the parks. But one of the exciting new developments was Disney Plus, which had been a long time in the making. And it's essentially like the Netflix for Disney. They've put the back catalogue online and they've started creating some new shows which will just go directly to their online streaming service. Yeah, so it's got, obviously it's got the sort of the Disney cartoons and films, but it's also got Pixar. and it's got Star Wars and Marvel. So Mandalorian was part of the Star Wars series, and that's their first major show that they've launched, which has been very successful. They're already over 70 million subscribers in the first year, and it looks like a lot of growth could continue. Also, they've got ESPN, which is sort of delivering live sports in the US, and the park side of the business, we would hope in 2021 would return as well. So it's a company that I would be happy to hold in the very long term with the strength of the brands and the strength of the business. And it's actually a company that I bought this year.
I also have Disney on my list. We've talked about it a couple of times already, so I won't go too much into it. But I think on its own, without Disney Plus, it is a fantastic company. It's a company that it goes in with the Unilevers and the Diageos, where you can just buy it and forget about it, and it's a quality business. I think it's not cheap. Forgetting Disney Plus, it's not cheap, but I'd possibly still pay up for it. So then when you throw in Disney Plus with 80 million subscribers in the first year, they're targeting, I think, 240 million by 2024. If you look at what that could add to the bottom line, I think it is very, very reasonably priced. And I think it's just a fantastic business. So yeah, I'm happy to have that in there.
Happy to have Disney. Okay. What would your next pick be?
I had Berkshire Hathaway on my list.
Okay.
And
do you want to, for anybody who doesn't know, do you want to explain a bit about Berkshire?
Yeah, so Berkshire Hathaway started life as a textile business, and then in 1965, it was taken over by one of its shareholders, Warren Buffett. I won't go into the massive details, but he's basically used Berkshire Hathaway as a vehicle for all his investing for the next, whatever it is, 50 years. He's built it up into just a phenomenal business. It's got a large portfolio of equity, so about 20% of the market cap's actually Apple. It's got about 70 businesses which are owned entirely by Berkshire Hathaway. So, for example, Geico, which is the second biggest insurer in the US, it's got a huge insurance and reinsurance business. It owns an entire railroad. It's possibly, in my opinion, the most well put together business ever assembled for a conglomerate. It's just absolute, the stuff that's in it, and it is trading very, very reasonably. I think it's just an unbelievable company. It's managed by the best capital allocator of all time. Admitted he's 90 years old, so he's not going to be around forever. But
does that put you off?
No, it's set up so well. It's not going to do as well in the future as it's done in the past when Warren's gone, but that's not to be expected anyway. It's obviously not going to carry on compounding at 20% a year because it's just too big now. It's probably going to move along with the S&P, but it's I can't imagine it doing that much better than the S&P, but I think it's much higher quality. I don't think there is some quality in the S&P, but there's also a lot of stuff that isn't as good. Whereas with Berkshire Hathaway, it's just absolutely quality. I mean, if I had to hold one stock for the rest of my life, it'd be Berkshire Hathaway without any second thought. It's just such a good business, and even though it probably won't do as well without Warren, those businesses that are wholly owned, I mean, he has no involvement with the management of the businesses. They will do fine without him. Where it'll struggle is the allocation of cash, but it started repurchasing shares anyway. It could pay out a dividend. There's lots of ways to allocate the capital without having the world's best stock picker, although that is obviously a plus.
Yeah, and it's got a market cap of over half a trillion.
500 billion, yeah.
Yeah, no.
Are you happy with Berkshire?
Yeah, I'm very, very happy with it. One that I was wondering about was something that Warren Buffett has bought and has been part of the Berkshire portfolio, which is Kraft Heinz. Did you have any thoughts on Kraft Heinz?
It's not made it onto my list.
Okay, so I suppose you could make the argument for it being quite a defensive company. I mean, the sort of brands that it owns are things like from Oreo to Heinz ketchup, baked beans. It's got a very strong portfolio of brands. It had a sort of unsuccessful merger between Kraft and Heinz in the last couple of years. It took on a lot of debt as part of that merger, and it's with the accounts as well, it's really suffered after that. About 18 months ago, it had been trading sort of in the $80-90, and then it had a big fall, and it was sort of now in the sort of 20s to 30s. I think as we speak, it closed at about $34 a share. So it's really in the process of turning around and paying down the debt. It's still yielding after the dividend cut about 5%. And I think while it's had a bit of a torrid time in the last few years with 3G Capital and some of the sort of the merger and the sort of failed cost-cutting attempts, I think the strength of the brands in the portfolio and the current price, I think it could be an attractive turnaround play.
It's not a business I'm overly familiar with. It's not one I'd have probably put in, but you know it well enough that I'm happy to let you state your reputation on it.
State your reputation. Well, I have invested in it myself, so.
Right. Well, that's good enough for me then.
What would your next one be on the list?
I've got EA Interactive on mine.
Okay, go for it.
So it's Electronic Arts. I mean, I'd describe it as the Disney of video games, really. It's got the Star Wars franchise, it's got FIFA, it's got the NFL over in the US, it's got Star Wars, it's got the Battlefront games, it's got the Sims. It's just got it's got a catalogue of very high quality games. It's trading at a PE ratio for the trailing 12 months of 31.6. But what's happened with it over the last few years is that as games have switched to going digital and they're downloaded, the gross margins have gone up massively. And I think they'll continue to increase. It's grown, and also they've been able to do more like in-game purchases, although the players don't like them. That's something that massively has taken off in the last few years, like FIFA Ultimate Team and stuff like that. And again, that's meant that there's historically, when you bought a game, that was the end of it. Whereas now you buy the game and you keep buying stuff within the game. So it's just so much more profitable for companies like EA. I think it's just a quality company. I think at a PE of 31, I think it's quite reasonable. I just think it's a quality business, really.
Yeah, no, I would have no issue with holding EA games. So we can put that in.
Right. I struggled with the US just because there's a lot of quality businesses, but they're just so expensive.
Yeah.
I really, really struggled. So I'll go down the rest of my list. So I've got Pinterest was on the list. So that's the social media company.
Yeah.
It's had a very, very good year. So it's trading at about $71 a share.
Yeah.
It went public in about April 2019 at about $30 a share. It's up about 3x this year, I think. It's got a market cap of about 43 billion, which as a price to sales, I think it's possibly about 35. But sales have been hit quite badly as a result of coronavirus because there was an initial cut on advertising. But the user numbers, it's got monthly active users of 400 million. It's currently only monetizing the international users to about 5% of the level of the US users. So even if it can't maintain the growth in users, which has been very respectable in the last few years, it can still massively increase revenue just by increasing the monetization of the users it's already got.
Mm-hmm.
It is not cheap, but I still think it's a business that has potentially quite a long way to run.
Yeah. Yep. No, I wouldn't bet against Pinterest. I'd be happy with that.
Okay. Next on my list was Etsy, which is, again, it's a company that we've covered. It is a phenomenal business. It is unfortunately a very expensive business too. It's got earnings though. So it's trading at a PE of 102. However, this is for a company with a $24 billion market cap and a company that is currently growing at about 130% a year revenue. So that earnings, that PE ratio soon comes down. I think I think it's not cheap, but it's when you look at what else is out there and just how phenomenal the growth is, I think you can make an argument that it's still fairly reasonably valued. I'd argue it was quite undervalued before. Although it's done very well from the low, so its 52-week low was 29 and it's up at 190 now. It actually, within the last 5 years, it had already been as high as about 70. So it's only really about just up about 150% from where it was a couple of years ago, and that's when it was growing at more like 30% a year. So I think it's justified, and like we said when we drilled down into it a bit more on a previous episode, it is a very, very impressive business.
Yeah. No, it's I would agree with you there. Not cheap, but I mean it's. I suppose it continues to meet expectations or beat expectations. So,
and there's a lot of companies in the US where there's similar sort of growth stories, but the growth is worse. The company doesn't seem as, I don't know, just as obvious, for want of a better word, and it's trading at much higher multiples than Etsy. I don't understand when you look at how some of the other stuff price, why it's still what I'd consider relatively low. I think to me, it just seems like a business it just seems obvious. I mean, like, especially like with Christmas, like I've noticed quite a lot of people getting like homemade gifts and stuff, and anything where it's more personalized, they go into Etsy, not Amazon.
Yes.
And I use it fairly frequently myself as well. So I just think it's a phenomenal business. So next on my list was Facebook.
Okay. Yeah. A company we're all familiar with.
Yeah. So 2 billion monthly active users, I think, across all its platforms. It might be even higher by now. That figure's possibly about 6 months old.
So what are its other platforms then?
So it's got Facebook, Instagram, WhatsApp. Mm-hmm. It's got something else as well, isn't it? I don't know if it's Messenger. I don't know if that counts as a separate one.
It used to be part of Facebook. Well, it used to be part of.
They make you have a separate app now, don't they?
It's now a separate. Yeah.
So it's another platform for giving you adverts, and they've also got Oculus, which is the VR gaming headset thing. But it's only trading at a PE of just over 30.
So in terms of US tech, that's not a lot.
No, and the growth is slowing, but compared to where it was 5 years ago, it's still trailing 12-month revenue. It's about $73 billion, and that's compared to 27 billion 5 years ago. The growth is slowing, but it's still growing. And I think if there's anything to be learned from Google, it's that a company the size of Facebook could still grow at 10 or 15% a year for the next 5 or 10 years. And if it can do that, given how much of that cost will increase as it does more to like combat like fake news and stuff. But I think given how much of that extra revenue is going to go straight to profit, I think a price to earnings of 30 is very reasonable. And I think the reason it's so depressed is probably because people are concerned about it being broken up. But to be honest, I think that'd probably be quite a good thing. Because I think if Instagram and Facebook and WhatsApp and Oculus were all valued as separate companies and it was broken up, I think they'd be worth more than the 760 billion that Facebook's worth today. I think you could make an argument for Instagram being worth 300 or 400 billion just on its own.
Yeah, I know. I don't think that's an unreasonable point to make. I think that's it could be the sum of the parts. Yeah. All right. So Facebook on the list.
So next up is a company called AlterX. It's I don't know if it's a company you're familiar with at all, John.
It's not actually. No, tell me about it.
So it's a data analytics platform. It's probably the way to describe it in one sentence. Okay. So it's one of these software as a service companies that are all the rage. It's trading at a price to sales of about 20, which is, whilst traditionally quite expensive, it's quite cheap compared to a lot of the other software as a service companies. So the reason the price to sales is so low is because the growth has been slowing. So its trailing 12-month revenue was 491 million compared to 85 million 5 years ago. However, in the year end 31 December 19, trailing 12, the revenue was only 417 million. So it's dropped to about 25% growth a year. However, that does include the pandemic where it did slow quite considerably and now it's picking up. So it's a bet on the growth. I think it can get back to growing to about, it's not going to be growing. I mean, there's some years where it's doubled and it's probably not going to be going back to 100% growth, but I think it can get back to 30 or 40% growth a year. And if it does that, I think it's quite cheap. It's maybe not, its market cap's 8.5 billion. If a lot of other US stocks more reasonably valued. It's possibly not a company I would have picked, but in light of how expensive everything else is, I think it looks quite reasonable if they can get the growth rates back to what they were a year or two ago.
Yeah, so we'll have that as well. How many more left?
Just one.
Okay, one.
And then there's a discussion to be had about number 10, because I could only come up with 8, and then we've added Kraft Heinz.
Have we? Oh yeah, we have. Yeah.
So the next one is a company called Ozon.
Again, something I haven't heard of.
No. So Ozon is the Amazon of Russia.
Okay, wow. So how does it compare with the Amazon of America, Amazon?
Well, so its market cap's a lot smaller. It's about 7.5 billion. It only IPO'd about a month ago.
Yeah.
It's at a price to sales of under 10, which is, I think, the main risk is the fact that it's Russian. It's also quite a fragmented market in Russia, and it's not at the minute the market leader. However, the 3 largest platforms, I think they make up less than like 25% of the market anyway. So that's not really a concern. I think the gross margins are about 30%, which that's about the same as C Limited, which we looked at fairly recently, but it's lower than Mercado Libre's 50%. But I guess that's because Mercado Libre's includes its Mercado Pago or Pago platform, which is basically like the PayPal of Latin America. The growth is impressive. Revenues 876 million in the past 12 months. That's up from about 600 million in the year ended 31 December 19 and 370 million year ended 31 December 2018. So it's growing quickly. I think the valuation is quite reasonable. It's at price sales. It looks like it's price sales for 2020 of about 7 or 8. The internet penetration in Russia is not as high as it is in the West. And again, it's one where there's other companies I'd possibly like to add, but they're too expensive. And I think because this is a Russian company, it's not being valued as highly. But I think if it can maintain the growth it's already doing, it's got a very reasonable chance of quite considerable capital appreciation without going into massive detail.
Yeah, so we'll put that down.
Okay. So then that takes us to 9. And I struggled to find a 10th. So I'd suggest doubling up on one that we've already got.
Okay. And just recap what we've got so far.
So we've got Berkshire Hathaway, Kraft Heinz, EA, Pinterest, Disney, Etsy, Facebook, AlterX, and Ozon.
I mean, I'm biased, but I'd double up on Disney probably.
There's 2 or 3 that I'd have been happy to double up on, and that is on the list. So Disney it is.
Okay, Disney.
Right, so I can add them in at the end, actually. So, right, I'll add them to the portfolio. So I'll just recap what we've picked. So we've split our £1 million fantasy portfolio. We split it into 20% commodities, 40% index funds, and 40% individual stocks. For the 20% commodities, we've gone 17.5%. The Bloomberg Commodities Index, Invesco Bloomberg Commodities Index, and the remaining 2.5% we've put into Bitcoin. For the 40% index funds, we've split that between 5 funds. One of them's tracking the S&P 500, another's tracking Japan, another emerging markets, another developed Asia, excluding Japan, because we've already got that, and the other one's developed Europe, excluding the UK. The individual part of the portfolio is split 20% UK, 20% US. The UK portfolio, it's split equally. So 2% allocation to each of Unilever, Money Supermarket, HomeServe, Hargreaves Lansdown, Segro, Taylor Wimpey, Rightmove, Diageo, AstraZeneca, and Tesco. And for the US portion of the portfolio, we split that between Disney, which is a double allocation, so that's 4%, and the rest of them being 2%. Berkshire Hathaway, Kraft Heinz, EA, Pinterest, Etsy, Facebook, AlterX, and Ozon. Any closing thoughts on your expectations for the portfolio, John?
We'll see. We'll see how it does.
I think it's got a reasonable chance of beating the market.
Okay. And let's clarify. What's the market?
What do you think?
I think the world index should be what we're comparing it. No, I do.
Okay, we'll go with world. What's the world index for reference at the minute?
So let's just have a look.
See, I don't like the world index because it's so heavily weighted to the US. If the US has a good year,
well, Sam,
we'll use it.
It's up to it's.
I'm just getting
it's the capitalized world.
Right. Okay.
Okay. So as far as I can see, it's trading at it's 2,659.27.
Right. So that's on the 28th of December 2020. Right. So that's our benchmark. So how do you think we'll do against that?
Okay. So it's difficult because, like you say, if the US has a good year, obviously the world index, because it's based on market cap, is overweight US in that sense. I don't think it's going to be easy for sure, but it's possible. We can hope. And if there's a bit of a rebound in the oil price, then our portfolio has probably got a bit more allocation to that. So it could be positive if there's honestly, I just don't know. What do you think?
I mean, the index, it's hard because the index is, like you say, if the US has a good year and emerging markets doesn't, and a few of the other indexes don't, we're going to struggle. But I think we've picked some quality stocks. So I'd hope that at least that portion of the portfolio can outperform. I think even if it does, it's going to be dragged down by the fact that we've got the indexes and the commodities. So I mean, if it could do 10% a year, that'd be fantastic. I mean, obviously, but that would be. I think it's not a guarantee, obviously. But I think it's reasonable to hope for that.
Yeah.
And what I think is quite good is that if, say, some of the individual picks go disastrously wrong, there's a lot of quality in there. There's a lot of indexes in the commodities. I think one thing that Buffett talks about is, when you buy something, if you should buy it on the basis that if the market was to close for the next 5 years, you'd still be able to sleep well.
Yeah.
I think if the market was to close tomorrow and we've allocated the way we've allocated it, I wouldn't be too concerned about what state it's going to be in 5 years' time when the market reopened.
No, I think that's a fair point, and it's probably quite a useful bit of advice for all investors.
And I think even if it doesn't outperform the market, it's probably going to be less volatile than a lot of portfolios.
Yeah, so the beta.
It's quite defensive, and it's a portfolio probably. I think it's got a few elements in there where it could do very well, but it's more geared towards sleeping well than eating well.
Yeah. No, it'd be interesting, to look at the beta for the portfolio and see how it compared. But if
we got a situation where it's slightly underperformed, but it was still a respectable real return, and it's had quite low volatility, I mean, that's not a disaster anyway, is it?
No, absolutely not.
So fingers crossed.
Fingers crossed. All right. See you next time.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.